$50 is sitting in your wallet right now, slowly losing value like a car the second it rolls off the lot, and the stock market is literally right there. Okay, real talk. You have $50 in your pocket right now, and you are sitting there thinking, what do I even do with this? Buy a new video game? Grab some takeout? Maybe just let it sit in your bank account for the next 3 years doing absolutely nothing, while inflation quietly eats it alive like a slow zombie? Yeah, that last option is what most people choose without even realizing it. And today, we are going to fix that together. Before we dive in, quick disclaimer, because I care about you. Everything in this video is for educational purposes only. I am not your financial advisor, I am not your accountant, and I am definitely not your mom. Please do your own research and consult a licensed professional before making any financial decisions. Now that the boring but important stuff is out of the way, let us get into it. So here is the big question that probably brought you here today. Can you actually start investing with just $50? And the answer is an absolutely thunderous yes. Not a hesitant little yes. A full-on, confident, standing ovation kind of yes. And by the end of this video, you are going to know exactly how to do it, step by step, without needing a finance degree or a trust fund or a mysterious uncle who works on Wall Street. Let us start with something super foundational. What even is investing? Because a lot of people hear that word and immediately picture some guy in a suit yelling into a phone while staring at a bunch of charts. But investing is actually so much simpler than that. At its core, investing is just putting your money somewhere so it can grow over time. That is it. You are basically hiring your money to go out and work for you instead of just hanging out in your wallet, being lazy. Now here is where it gets really interesting. Have you ever heard the phrase compound interest? This is the secret weapon of every person who has ever built real wealth from scratch. Let me break it down in the simplest way possible. Imagine you plant a seed and that seed grows into a small tree. Now that small tree starts dropping its own seeds. Those seeds grow into more trees. And those trees drop even more seeds. Before you know it, you have got a whole forest and you only started with one single seed. That is compound interest. Your money earns returns, and then those returns earn their own returns, and it just keeps snowballing. The longer you let it sit and grow, the more powerful it becomes. And here is the wild part. Time is the most important ingredient. Which means starting today with $50 is genuinely better than waiting until you have $500 someday. I know that sounds backwards, but it is absolutely true. Okay, so now that we understand why investing matters, let us talk about where to actually put that $50. Because you have got options, and some of them are way more beginner-friendly than others. Option number 1 is a brokerage account. Think of this like a special bank account specifically designed for investing. You open one up, put your money in, and then you can start buying things called stocks and exchange-traded funds, which you might have heard called ETFs. A stock is basically a tiny piece of ownership in a company. When you buy a stock, you own a little slice of that business. If the company does well, your slice becomes more valuable. If it tanks, well, your slice loses value. That is the risk involved. ETFs are a little different, and honestly, for beginners, they are often a smarter starting point. An ETF is basically a bundle of many different stocks all packaged together. So instead of betting everything on one company, you are spreading your money across dozens or even hundreds of companies at once. This is called diversification. And it is basically the investing version of not putting all your eggs in one basket. If one company in your ETF has a terrible year, the others can help balance it out. There are brokerage platforms out there today that let you start investing with no minimum balance. Some of them even let you buy what are called fractional shares, which means if a single stock costs $200, but you only have $50, you can still buy a quarter of that stock. The barrier to entry has never been lower, and that is genuinely exciting. Option number 2 is a retirement account. Now I know the word retirement might make you think of old people playing golf, but hear me out. If your employer offers something called a 401k, especially if they match your contributions, that is basically free money. Always take the match if you can. Even if you are putting in a small amount, getting that employer match is like getting an instant return on your investment before the market even does anything. If you do not have access to an employer plan, look into something called a Roth IRA. This is a retirement account where you invest money that you have already paid taxes on, and then when you take that money out in retirement, you pay zero taxes on the gains. Zero. That is a massive deal. For younger investors especially, a Roth IRA is one of the most powerful tools available. You can open one through most major brokerage platforms and contribute up to a certain amount each year set by the government. Now, let us talk strategy, because having an account is just the beginning. What do you actually do with your $50 once it is in there? For beginners, one of the most recommended strategies is something called index fund investing. An index fund is a type of ETF that tracks a specific market index. For example, the S&P 500 index tracks the 500 largest companies in the United States. When you invest in an S&P 500 index fund, you are essentially investing in the American economy as a whole. Historically, this index has grown over time despite short-term ups and downs. Past performance does not guarantee future results, but it gives you a sense of what long-term investing can look like. The strategy here is simple. You invest consistently. You ignore the daily noise and drama of the market, and you stay in it for the long haul. This approach is sometimes called dollar-cost averaging. That just means you invest a fixed amount regularly, like $50 every month, regardless of whether the market is up or down. When prices are low, your $50 buys more. When prices are high, it buys less. Over time, this evens out and can actually work in your favor. Here is a question worth sitting with. What would happen if you invested just $50 a month starting today? Even with modest average returns over several decades, that small, consistent habit could grow into something genuinely significant. The math gets pretty mind-blowing when you let compound interest do its thing over long periods of time. That is not hype. That is just how the numbers work. Now let us talk about something that trips up a lot of beginners. The emotional side of investing. The stock market goes up and it goes down. Sometimes it goes down a lot, and it feels absolutely terrifying. You will open your app one morning, see that your portfolio dropped, and your stomach will drop with it. This is completely normal. Every investor goes through it. The key is to not panic and sell everything the moment things look scary. Think of the market like a roller coaster. The ride goes up and down, but if you stay in your seat and do not jump off in the middle of a dip, you almost always end up back at the top and higher than where you started. The people who lose money in the long run are usually the ones who panic sell at the bottom and miss the recovery. Staying calm and staying consistent is genuinely one of the most valuable skills you can develop as an investor. One last thing before we wrap up. Learning. Keep doing what you are doing right now. Watch videos like this one. Read books about personal finance, follow credible sources, and keep asking questions. The more you understand how money works, the more confident you will feel making decisions with it. Knowledge is literally one of the best investments you can make. So let us do a quick recap of everything we covered. Investing means putting your money to work so it can grow over time. Compound interest is your biggest ally, and time is your most important asset. You can start with $50 using a brokerage account or a retirement account like a Roth IRA. ETFs and index funds are beginner-friendly tools that help you diversify. Dollar-cost averaging means investing consistently no matter what the market is doing. And staying calm during market dips is just as important as picking the right investments. You do not need to be rich to start investing. You just need to start. That first $50 is not just money. It is a decision. A decision that your future self will absolutely thank you for. Drop a comment below and let me know if you found this helpful or if you have any questions. And if you want to keep learning how to build your financial future from the ground up, make sure you subscribe to Chosen Few Finance Education, because we have got a whole lot more coming your way. See you in the next one.